right, so let's talk about international funds, which always prefer to be a part of your portfolio, and the specific purpose definitely is diversification. But which international market can you look at the current moment? US market showing concerns over growth, Europe facing crisis at various ends, fraction of Asian markets doing well though, but China underperformance continues. So where and how much is the scope for you to have your money put in international markets in various geographies? Let's understand. I have with me Nirav Karkera, Head of Research, Fisdom. Nirav, hi, good evening and welcome to the show. We always recommend international funds for those kind of investors who had their core portfolio in place. But then looking at the current juncture and the kind of the trajectory that the world economies are having, the thought that we all had at the beginning of 2024, a lot has changed now within a month or so. Let's look at economy-wise, okay? And let's start with the US market. A lot of people have US-specific exposure in their portfolio via funds or maybe even through stocks. But let's understand the kind of current momentum as far as US-specific economy is concerned, and also for those people who want to buy something US-specific.
So, Kavita, US is at very interesting crossroads today. Even if we look at it from a macroeconomic standpoint and extend the premise to broader markets in the US, especially equity capital markets, all of this is at very interesting crossroads. And I call it interesting because US has been under pressure for the longest period in time. In fact, India seemed to have recovered from the post-pandemic quantitative tightening process much faster than the US. And the US was, sort of struggling with it since quite some time now. However, the US appears committed and willing to get out of the woods finally. In the most recent address, the US Fed also indicated how it is expecting three rate cut cycles over the next couple of quarters, right? So there is an indication that that the economy is gaining a firmer control over the inflationary situation, and growth is getting back to normalcy. And with the interest rate cuts coming in, the expectations also of such a cut is really buoying the sentiments and instilling a lot of business confidence. So the outlook for the broader equity capital markets has been really upbeat, and it is also reflected in the way US equities have performed in the past. Right at the top of the funnel, you have the broadest basket of S&P 500, which performed on an average, delivered 25, 27 odd percent. And as you move towards more concentrated baskets like the NASDAQ 100, which is tilted towards technology, we could see a much better performance over the past trailing year, which brings it to the range of almost 50%, which is double of what the broader index was. You further narrow it down and use a proxy, for instance, Mirai Assets Bank Plus ETF FOF, which is a big tech focused play. The returns there were almost 90% for the trailing 1 year period. So this clearly indicates how big tech is leading the growth in equity capital markets in the US. And this is a very good indicator of the growth prospects, because tech, especially big tech, has been highly sensitive to growth prospects and interest rates. If you recollect, post pandemic, at the very first hit, these were the ones who were the worst impacted also. So going forward, we expect the outlook for US to be positive. We view it positively, and we expect that the growth seen in tech starts percolating towards the broader segments of the market as well.
Nirav, let's also quickly focus on the various Asian markets, or the bouquet of emerging markets also. Talking about Asia-specific markets, so we have Nippon India Taiwan equity, where if we look at the return, 1 year's return is almost 36.7%. Nippon India Japan equity is almost 16.5%. This is the 1 year's return mark that I'm talking about. Otherwise, you did mention about NASDAQ specific, US specific, which is Motilal Oswal Nasdaq, if we have to count in Motilal Oswal S&P 500, where we've seen Motilal Oswal Nasdaq, going beyond 45%, and Motilal Oswal S&P going beyond 20%. But specifically Asian markets, Nippon India, Taiwan equity and Japan equity. So what pockets in the Asian markets are very attractive right now, according to you, looking at the fund performance? Definitely, can we look at Japan and Taiwan markets? But this is again 1 year's performance because of the data available of the funds, yeah.
Correct. So, like you rightly pointed out, I would love to bring that to fore and, flesh it out a little bit more. The Asian markets is fairly diversified and fragmented. We have reached such a time in the world where we have to talk about Asian markets as Asian markets and Asian markets excluding China, right? So, talking about the ex-China piece first, like you rightly highlighted, Taiwan and Japan are two such pockets that are doing phenomenally well, and there are a few things that are going in favor of these two economies, right? So Japan's increased focus on corporate governance and its continuous policy-led nudge on improving corporate governance structures and the push towards for corporates to generate more and more shareholder value is actually bearing fruit. And if you see, even at a broader headline level, Japanese equity capital markets are doing phenomenally well in the longest period of time. At the same time, you look at the Taiwanese markets, and why just Taiwanese? You extend it slightly more to South Korean markets also. Both of these pockets are really promising, and they're really promising. One majorly on the manufacturing side of life, and two on the consumption side as well. These two factors are really boosting sentiments for these two economies. The entire wave of digital that is surrounding the world and the need for digital for the inputs that go into a digital story, for instance, semiconductors, find a very strong base in Taiwanese markets, and every other digital hardware assets also find a very strong manufacturing base in South Korea. So the only thing that might not be particularly thrilling is about how these economies are particularly mature in its own in its own right, and the scope for incremental consumption is not really as robust as most other middle income early growth economies like China and India. So a quick move towards China, and I'll tell you that China has been at the center
Us.
stage of
That's what I
growth.
was also wondering, that what's actually ailing China, because I think since 2022 we are looking at first the housing market going down, and then there was COVID, which was a very long one for China, and then later on we have their internal political tensions which are going on. So a lot of questions on stability, on their exports, on their manufacturing, etc., are still around. So how long do you think this is going to continue, because the performance is definitely impacting China specific funds?
Yeah, so you exactly highlighted the thing that is really affecting China, right? So the housing industry, the realty industry is among the more key industries within China, and it has been ailing for the longest period in time. At the same time, the deflationary pressure in China seems to sustain for much longer than what was initially anticipated. In fact, if you look at the youth unemployment figures, they are also at record levels, and consumption also as a byproduct of these primary factors is also slowing and not as upbeat as it used to be earlier. So China is definitely under a lot of pressure, and just very recently, as much as within the last couple of hours, there has been a confirmation that China is aggressively looking to rescue its capital markets and raise funds through offshore fund houses, and try resurrect the Chinese equity capital markets. So China has also taken cognizance of the fact that all such things are bearing heavy on the prospects of China Inc. that was called at one point in time. And going ahead, this is not an easy thing to resolve, right? So even if you put together a rescue package, it is at best a band-aid solution. The structural problems still remain intact, and all these structural issues continue to bear really heavy on one. You can also see it in their sovereign ratings, right? Just as a side note, and finally, the proof of the pudding is in the eating. You can see it in the performance of the asset classes of the Chinese economy. So it is really far from turning around the corner, I'd say. We need to really keep a close watch and keep a close tab on how the situation develops. And how does the Chinese government react to such development situations before we take a very strong stand on how it's shaping for investors in India.
Call to exit the fund, China specific fund, is that what you're also trying to say?
Yeah, so if you have a really long-term horizon and you really believe China will turn around the corner and you believe in that narrative, please hold on. However, looking at the alternatives that are available and the fact that most Chinese funds in India have been out underperforming, you might want to look at alternatives that are much more better positioned, and where the probability of success is much higher and much sooner, at least from an anticipatory standpoint. So from that perspective, there is a very solid case to move out of China funds and diversify into other equities. It could even be domestic.
Do you also recommend a much more diversified fund? Maybe, here we can look at PGM India Global Equity Opportunity Fund, where you have various markets involved in one particular fund. Should we be looking towards these kind of funds? Because clearly the US oriented funds are a thumbs up from you, looking at the kind of trajectory that we are talking about, that we also discussed. But is it also time to just, if you already have those kind of exposure, then it's fine. But if you are someone who's wanting to invest, better go for a diversified fund.
Yeah, so diversifying is always a good idea, but one important thing to understand is simply adding more stocks is not necessarily diversification. And simply adding stocks from various different economies doesn't mean you're well diversified and you will capture every upside that is possible. So there's a very thin line between diversifying and over diversifying. So while there are a few funds that are doing well, so like the PGM fund that you spoke about, that's also a good fund, but one needs to be very sure of the underlying constituents. Those are the economies, those are the sectors, and those are the allocations that you want to play, by all means, please go ahead. But just because it has a variety on offer doesn't mean it will solve your needs specifically. Because if you think about it, if it has a certain allocation that is well positioned for an upcycle, and another allocation that is clearly not well positioned for an upcycle, one thing is just going to set off the other, and you're going to land up with less than average returns by sheer logic, right? So be very sure of the allocation of the holdings, and if you feel that's what you're particularly optimistic about, by all means you must go ahead. And no matter what, please ensure that you have a very long term horizon, because economic cycles are much longer than market cycles or business cycles. So if you are taking a top down approach, you may have to stand in there for slightly longer.
Or else what you can do is just send across your questions to the Money Show, and we will help you invest, or guide you towards your investment in international funds. Thank you so much, Nirav, for being on the show and helping our viewers with this today. On that note, let's take a quick break, but then post that we will be joined by Pankaj Matpal, who will be answering our viewer queries. So just in case you want to send us your question, you can do that via WhatsApp or email ID.